Okay, let's get started. So it's just coming on 10 o'clock now here in the UK. Welcome everyone to this morning's presentation. It is Monday the 28th of January 2013. Just a quick look ahead at the calendar before we hit the charts. Fairly light at the beginning of this week, but on Wednesday we've got the federal funds rates announcement to look forward to. We also have the Reserve Bank of New Zealand issuing its latest interest rate decision on Wednesday. On Thursday there's Canadian GDP and as well manufacturing PMI out of China. The Chinese numbers seem to be becoming more and more important as time goes on, so well worth keeping an eye on those. Not so much the numbers themselves, but the kind of volatility that comes about just before, during or after them. And on Friday we have the NFP, so non-farm payrolls data being released over in the States, which always tends to kind of give off some fireworks. Alright, we're in quite a healthy position at the moment as far as trading is concerned, in the sense that it is more about position management at the moment than anything else. If we turn, so we're going to work through the Euro GBP, the Pound Swissy. We're going to look at Dollar CAD, which we initiated last week. We're going to be looking for an entry on the Pound Kiwi this week, so I'll be explaining that entry, and then after that maybe we'll take a look at the Euro USD and the Pound Swissy, just for some kind of general observation. So here goes. First off, Euro GBP. Alright, so this has been an absolutely fantastic. It's been phenomenal, right? The Euro GBP. She's gone and hit target. Not only has she hit target, she's blasted pretty much through it. The lines which you're seeing on my screen are all the positions that I'd initiated on the Euro GBP and where I took profit. So you can see pretty much going back to August of last year, when we started buying the Euro GBP, started looking for that 85 target. This is actually a neat trick that someone shared with me last week, which is that if you're using MT4 and you go to your historical trades, and any trade that you've closed, if you drag it over onto your chart, it'll map it onto your chart and show you where your entry was and where your exit was for those positions. So for 6 or 7 months now, all I've done is traded long on the Euro GBP, and it's paid off every single time. I have a couple of positions which are left active now. Only 2 positions left active after kind of initiating maybe 15-16 trades on this pair, right? So all the added trades are closed off now. Just a couple of the original positions left in, more for the sake of vanity than anything else. She's still breaking north, and so it's a question of seeing how far the price can extend rather than anything else. My expectation now for the Euro GBP is actually that she is going to end up pushing much higher. Initially my target was 85, but I'm talking now 86, 87. And I think that if she is able to reach that 87 block in a straight line, so we're looking somewhere around here, right, inside of this price cluster over here. But if she's able to reach that in a straight line, then at that point it would be worth to start looking for a corrective move on the Euro GBP. And although I've been trading longs on the Euro GBP for 7 months now, I think that once she reaches that level, all you have to be doing is to be marking some kind of lower trend line, and once that trend line breaks, I would start looking for a significant correction to the downside, possibly coming in for a retest of this area here. Right, so I'm looking for a retest of the 82.50 area. My expectation is going to break higher, and then she's going to end up breaking down. So the active positions long that I have left on Euro GBP, if the price goes and reaches 87 or the upper 86s, then those positions are going to be completely closed off. Right, I'm not going to keep those vanity positions forever. I'm expecting a correction from around that price, and not only am I expecting the correction, but I will be trading that corrective move also. Right, so if she goes up towards 87, the last of those positions ends up getting closed off, and then I'm going to be looking for a trigger short, and to the downside I would be looking for the price to pull back toward the 82.50 area. If she chooses to do that from where she is now, then I'm just kind of left leaving it alone, right? So again, it's that principle that we've discussed in previous weeks, that you can map the price, and once you've mapped it, if she moves according to your expectation, that's when you start initiating the trades. If she's not moving according to your expectation, then you have to kind of just leave it alone and say, or I don't need to do very much about this, right? So I've mapped it just based upon the way that price is moving right now. My expectation is for a further momentum north, possibly another 100, 150 pips from where she is right now. And then I will be looking for a short trade, and I'll be looking to ride that corrective move. I'm looking to ride it because I think that corrective move is going to be significant. It's going to be a few hundred pips. As you know, in Euro GBP, sometimes 30, 40 pips can be a lot of movement on this pair, right? It pretty much reflects its kind of average daily range for most parts of the year, right? So considering that we're looking for at least a few hundred pips corrective wave on Euro GBP, it kind of makes it worthwhile initiating that short trade, looking for that entry. But like I said, 87 first. Okay, we were looking Euro GBP long, and that also had us looking Pound Swissy short. Pound Swissy, I've got a few positions again still left open but cashed up. The most part of my positions are going all the way back to kind of November, December last year. They were initiated not even in this consolidation block, but they were initiated somewhere around this block here. Again, downside target, I think she still has a significant, I think there's still significant room to the downside on this instrument. You're looking at least another 250 pips down towards the 143 handle before you get significant structural support, which is visible on the daily. Based on the current structure right now, I guess as far as the shorts are concerned, it is all about this previous support area that the price has broken through, right? And you can see a little bit of a hooking structure there, support and resistance. But from a technical perspective, as long as the price remains below this RS level, then it remains a technical short, right? And that technical short, again, you can have your kind of downtrending trend line, and as long as the price is remaining below that downtrending trend line, the technical shorts remain very much in play. The Pound Swissy is inversely correlated to the Euro GBP. Those correlations seem to be back. The only thing that would be breaking that correlation would be the SNB, and they don't seem to be very active in the market just yet, right? So so just a little bit of wariness there on the Pound Swissy, but again, you know, position several hundred pips up. We've banked a lot of pips trading this short. It's just a case of tracing it structurally now. I'm looking for Euro GBP another 150 pips higher. So on a I guess just scaling in the proportions, we're looking at Pound Swissy about 200, 250 pips lower than where she is right now. If you like the risk definition, it does look as though that's coming in around the 47 handle, right? And I guess that's a bit too much for me to be kind of adding or chasing the instrument from based upon the current kind of price levels. But You've got your RS block there. It's on a higher time frame. From a technical perspective, as long as that holds, actually the short bias on the pound Swissy does remain very much intact. Okay, last week at this presentation we were looking at the dollar Canadian. Alright, so dollar Canadian, I've got positions which have been initiated after, I think the price was around here when we spoke, and so my position's in there somewhere. So it's coming in around the 99.30 area. The position is up now to the tune of about 200 odd pips. So it was quite a sweet trade. I hope most of you managed to participate in that. Again, it's been more a question of management. So I've taken off about half of it. I took off half of it at around about the 100 pip mark, just holding on to the balance, and I'll be doing a little bit more profit taking maybe later on today. My key consideration on this now in terms of profit taking is just going to be the lower trend line. If I get a lower trend line break, I'll be taking off most of the balance of the position and then waiting for a pullback before I start getting involved in this position again. I explained last week the technicals for the technical setup, or the reasons for initiating this trade. So on the wider time frame, we had a kind of SR flip take place on this particular okay, I'm getting my S's and my R's wrong, but that would be support, I guess. So we had support, resistance, support. The price had taken quite a strong momentum break off of that support level, so we were looking for that momentum to continue. Now, the issue is that on the upside we have quite a significant target on this. Right to the upside, I'm looking at 105, 106. I'm looking for a retest of those highs. The price now is near enough the 101 level, which means that there is still another 500 odd pips to play for. Now, as far as the kind of timing for that is concerned, I guess Euro GBP demonstrates more than anything else. You know, sometimes you expect it to happen over the course of a couple of weeks, and it ends up taking several months. Other times you might be expecting that something is going to take several months, and it will go and hit that target over the course of several hours. Alright, so as far as timing is concerned, that's something which is not easy to say. It's not straightforward to say. But as far as the directional bias is concerned, as far as interpreting the structure is concerned, that is about as straightforward as it gets. Right? So as long as the price is remaining and holding above this 98.50 block, then technically the instrument remains a long. That is the kind of critical issue. So it doesn't matter if you went long here, or if you went long here or here, or even if you went long there or there. Would you be right for going long at those prices? Well, as long as the price is above 98.50, technically you're right for having that long bias. The issue after that is, how do you get risk definition? Because it's not all about bias. Okay, you've got a net bias, but you need to have some risk definition. If you're going to trade, you need to be able to know what it's going to cost you in money and where that stop needs to be placed. Those are the kind of critical issues when you're trading, right? So I'm looking now for a pullback on the dollar Canadian. My net bias above 98.50 is a long, but despite that, my stops will inevitably end up getting placed above that level, right? I'm not prepared to risk a 200 pip stop on a trade. I will say, if you're having to take a 200 pip stop on a trade, then maybe you ought to be looking for a different profession, right? But so it's got to be a lot tighter than that. From a structural point of view, there are two areas of interest, and I'm just looking at the current wave. The first is the origin of the breakout, where the current trade has been initiated from, and the other area which I'm looking at is here. Is here, which is the base just after the breakout, and that is coming in near enough the kind of parity price level, right? So I think parity is probably going to provide pretty good opportunity for looking for a long trade on the dollar Canadian. The other key level, of course, to kind of bear in mind, is quite an important level, is the 99.47, 99.50 area in itself. That represents the yearly opening price on the dollar Canadian. So if you're imagining the yearly candle right now, the yearly candle has broken bullish, and if the yearly candle is breaking bullish, then you should expect for the price to carry on in that direction, right? In the same sense, if the price breaks down below the yearly open, it would mean that the yearly candle is looking bearish, and so you'd expect the price to carry on in that direction. So right now the bullish argument on the dollar Canadian is very, very strong. Like I said, we've got two issues. The first is position management. The other is using the pullbacks to get back into the trade, because we have an upside target on this particular instrument. So dollar Canadian, very much on the radar. This isn't going to, it's hard to say, but based on most recent experiences, it's not necessary that this is going to play out over the course of a few hours. It could happen that this takes a few weeks to play out. If that is the case, then right now I'm in a mode where I'm kind of waiting for a pullback. If I get a pullback, I'll be able to get back in on the full position. Otherwise, I'm quite happy holding the position that's already been initiated on this pair. Okay, next one up that we want to take a look at is the pound Kiwi. Whoa, she's gone. All right, so but it's okay. Right. Okay, pound Kiwi. I planned to discuss this last week, but I don't think there was a lot of time then, or in fact she was still falling, and I thought there's a little bit of time before that reversal happens. But pound Kiwi, I have an upside target where I'm looking back towards the yearly open in the first instance, which is coming in around the 96, and then after that back towards 2, right? So on the upside, we're talking about 1,000 pips almost on the pound Kiwi now. It looks as though she's ready to start giving that reversal, and it's more a question of how you get involved in this and how you end up playing it, what kind of trigger you use, right? I don't know if John is here, but I know John has been kind of clocking pips on this all last week, and he's been sending me pictures of every time you make it. There you are, mate. Right, so right, he's been clocking pips on this all last week, right? While I've been sitting out, but we think there's a significant upside target on this instrument. It's just a case of how you end up getting involved. You have your aggressive entries if you're an aggressive player, and you have your conservative entries if you're a conservative player. What it all comes down to at the end of the day is risk definition. If you're an aggressive player and you have that upside target, you can chase every break, right? So every break you see in that direction, just chase it. I'm sure it'll end up giving you some pips. It doesn't matter if it's a 4-hour candle or it's an hourly candle. You just chase the break using that candle in order to get your risk definition. As you can see, we've got some trendline breaks going on here, and again, it's another trigger which would have you looking in that northerly direction, right? So anytime I get a trigger north on the pound Kiwi, and again, this is something which may end up taking 2 or 3 attempts, but because there's a significant upside target, it's kind of worth attempting on more than one occasion in order to get into this trade. And it may well be that we have a fairly significant low which has been established here around about the 187 area. All right, so that's as far as the kind of bias is concerned, and as far as the target is concerned. What we really need to pay attention to, though, are the structural issues. All right, so and I think it's important actually to point the structural issues out on this, because they haven't changed yet. What does a downtrend look like? A downtrend looks like this, right? So what happens is the price drops, pulls back, makes resistance, drops again, pulls back, makes resistance, drops again, pulls back, makes resistance, drops again. I know I may be teaching some of you guys how to suck eggs here, but it's sometimes it's a useful reminder. And an uptrend looks like this, right? So the price breaks higher, pulls back, makes support. That's what it looks like. If we're looking at the current structure on the pound Kiwi, depending upon which time frame you're looking at, it really doesn't make much difference. But I guess if we were looking at the falling price, the significant area is here. Let me just get the kind of highs and lows in there. Alright, so the significant price area is this one here. Right, that is the resistance block which has been containing the price as she's been falling. So we can kind of see that quite clearly that the price has made resistance there. Some of you might be even looking at that and going, look, there's an inverse head and shoulders. But that is the block that's been containing the price. Right now, if you've been trading long on this instrument, and I know I've spoken with quite a few guys over the course of the last few weeks about this instrument setting up as it was falling, and we were talking about that 87 price handle and what the expectation will be once the prices reach there. So I know quite a few of you guys, and I'm just looking at the attendees list, I know there's at least 8 people in this room who are long on the pound Kiwi, right? But that is the resistance block which has been defining the downtrend last week on the pound Kiwi. All right, so it's a resistance block. So from a structural point of view, you ended up going long in anticipation of a reversal. Right now, what we're saying is, okay, how do you go long? Not in anticipation of a reversal, but with a structural confirmation that a reversal is taking place. That's the issue. So what you want to see is that turning into this, and then you know that you've got structurally a long bias, or I don't know, structurally there's a wave which is developing there, which is confirming a long position. I'm not always the most eloquent with words, right? So I guess I know what I'm trying to say. You guys are going to have to work it out. What that would mean to me, or what it would look like, is that once the price was kind of broken up high and broken through that block, then on a pullback I'd be looking for resistance to turn support. If she doesn't pull back like that, then after that breakout you want to see some intermediate support established. Something like this. Once you're seeing that intermediate support established, again it gives you risk definition, and then you can look for a much stronger push to the north side. You can look for a much stronger push in that northerly direction. Alright, so pound Kiwi, it's giving all the right signs right now. We had an expectation that she would turn up. We have a very significant target to the upside. Whether it happens or not, or how you trade it, is going to depend on how aggressive or conservative you want to be. I'm much more conservative with my entries. So right now what I would be looking for is something like this, something along these lines. Either we have a significant break up, a pullback, and we start seeing the previous resistance turning support, or we see an intermediate support getting established after the price has broken higher, and that will give us risk definition, and then we can look for the price to break up to the next level, principally during that consolidation, right? Which is, if you want to compare the technique that we used for dollar Canadian, it was very similar, or pretty much the same, and you can see the kind of payoff that is given, right? So that's what we're looking for from a structural point of view. If that starts happening, then we'll start playing, and we're going to get very, very merry indeed with this particular pick. My spread on the pound Kiwi is usually the upper 7, so it's around about 8 pips. But again, this is something that I've mentioned before, that what you want is to be trading an instrument that is moving. The spread doesn't really matter, all right? But if you're not happy with that kind of spread, or if your broker is charging something crazy, and I know some brokers on this instrument, they charge something like 13, 14 pips, which is really, really crazy, which means you'll be looking at changing your broker. But this pound Kiwi long, it's likely to represent Kiwi weakness more than it represents pound strength, right? So if you're looking across the board and if you want to do some of that kind of intermarket analysis, you look at all the pound crosses, they've been demonstrating a lot of weakness, right? So whether you're looking at cable, whether you're looking at GBP JPY even, although GBP JPY has been about yen weakness, but the pound hasn't been able to carry as much momentum as the other crosses against the yen. Whether you're looking at the pound Aussie, pound Swissy, we've seen like a lot of general weakness in the pound itself. So what that would suggest about what's going on here on pound Kiwi is that this is more about the Kiwi than it is about the pound. And my reason for saying that is, if it's more about the Kiwi than it is about the pound, then you're going to be looking for a continuation of this price falling on the Kiwi, right? And on Kiwi, the spread is under 2 pips, right? So if you're not good to be taking a long on the pound Kiwi, then perhaps you ought to be considering shorting the Kiwi dollar. And again, I'm on an H4 here, but as you drop down, I'm sure you'll find some kind of structure which would allow you to kind of get some risk definition in on this pair. I guess at the moment you're probably looking 83.20 and then an extension up to about 83.40. So you can get some decent kind of risk definition in on there, and if you're getting if you're getting decent risk definition, then you can be looking to be initiating a position. Again, because pound Kiwi, the upside target is so significant, I would suspect that on the Kiwi dollar, the downside target would be fairly significant. The orange line across the screen that we're looking at, 82.62, that is the yearly opening price on the pound Kiwi. It represents the yearly open, right? So again, right now the price is just kind of marginally above that level. But if it happens that the price starts breaking down below that price, it means the yearly candle has turned bearish, and then it would be fair to be looking for a significant move further in that direction as a continuation trade. Okay, so that's the pound Kiwi. Alright, let's just take a look at one or two more which I thought would be useful to take a look at this morning. First off, let's take a look at the Euro USD. Euro USD, I have a widely established viewpoint on this instrument, which is that I'm actually looking at the Euro USD probably hitting parity over the course of the next couple of years. The question is more, I think it's going to be more about, it's not about bias, it's about when you end up triggering that trade or when you start getting involved, right? And I tried some blind shorts at the beginning of the year. Those didn't really work out. The price ended up breaking north. But I guess I'm just not believing that she has a lot further to go. Right now, now that's my kind of bias. It's just an analysis which I have. It's actually based upon a price structure. It's based upon a pattern completion on a much higher time frame. But the issue is, it's one thing kind of having that, getting risk definition for it, and taking a trade is another thing altogether. So it may happen that she ends up breaking north for 1,000 pips and end up missing the whole of that rally. That's okay, right? Because nothing ventured, nothing gained, but at the same time, nothing lost. But if it happens that she starts breaking down, then I will quite happily give chase with a view that I'm actually building a position rather than an intraday trade, right, or something like that. So if she's breaking down, I'm going to be assuming that she's got thousands and thousands of pips to go to the downside. I guess that's what I'm trying to say now. The reason why the structure is interesting right now is because toward the tail end of last week she ended up breaking a little bit higher, and what's happened is she's worked through a resistance block near enough the kind of 34 handle. And what I'll be watching on the Euro USD this week, in fact you can see a trend wall which I've got marked. So there's my trend wall, and if it happens that we end up getting failure from around this price level, and the price ends up breaking back into our block here, right, then I would be looking at this break north flat 34 handle as a false break. And you know that usually when that happens, because I'm sure everyone's been caught on the wrong side of it on probably more than one occasion. But when that happens, then from a structural point of view, you can be looking for quite a strong break to the downside. All right, so Euro USD very much on my radar. It's on my radar because we've potentially got a setup coming here which could turn into a false break. If it turns into a false break, then I'm going to be trading it to the south side. All right. If it stays above that 34 handle, then technically what you're looking at is resistance turning support. In which case, if you have a long bias on this instrument, may the pips be with you, and maybe she has another 200, 250 to the upside remain. All right. I have a few other technical markers on higher time frames on this pair. So there's another trend wall here which I'm monitoring, and so I've kind of got her marked saying where am I going to be taking my shorts. Right? I've not got her marked in the sense that where can I get involved in a long. It's more a case of where can I take a short, and I'm quite happy to be playing that game on Euro USD. Like I said, that could end up meaning that I'm missing 100 pip rally or 1,000 pip rally or something like that, but that's okay. At the same time, I'm not going to be losing any money, because if I take an entry, it's going to be a technical entry with clear risk definition and with a little bit of wind in my sails. So I want to see her drop just a little bit first. But I guess in the near term, based upon the current price action and the current price structure, if this turns into a false break, at that point I'd be prepared to chase her short. As long as she's remaining above the 34 handle, she does actually remain a technical long, just based on the fact that you sensibly, the most sensible course of action would be to follow the most recent momentum, right, which has been to the upside. In a similar vein, we have the dollar Swiss, and the dollar Swiss, my expectation actually is that she's going to end up breaking higher, and I have kind of cause to be looking for entry around the 92 handle if she manages to dip that far. But I guess if a more technical entry is required, then the best thing to be doing is just to be kind of marking a trend channel there, and if it happens that the price ends up breaking up through that, then to be chasing momentum north on this particular instrument. But I think that again, 91.40 is the yearly opening price on this instrument. She's holding above there. If I see a momentum break north, I will be prepared to give chase to that on the dollar Swiss. So if my expectation is for the Euro USD to be falling, then I guess it's only fair for me to have a bias looking for dollar Swiss to be breaking higher, but with the key caveat that if you're going to take an entry on this, the wind isn't in our sails yet, right? And so you want the wind in your sails. You need it to be a technical entry with sharp risk definition. Those are the key critical issues when it comes to these. So no blind entries. I'm sure we'll end up revisiting these pairs over the course of the coming weeks, because it really does look from a structural point of view that something is brewing here, and something has to give, and you've got to get a strong break in one direction or the other at some point. I think strong break, I guess it means a convincing break, right? Which is something that I'm not seeing on Euro USD right now. Even though she's rallied 1,300 pips off her lows from the lower 20s, it's still not convincing enough, right? And I'm still getting a sense that I'm still getting a sense that it is corrective in a greater downtrend. So we'll be watching out for that over the course of the next couple of weeks, and I'm sure we'll end up playing it. Okay, folks, I think that is your lot for this morning. Certainly from what I wanted to cover. I think there's a few questions there, so I'll quickly have a gander at those. Right, let's start from, where are we? Okay, you're making like 3 trades per week. No, sometimes I make 1 trade, sometimes 2, sometimes 3 or 4. Quite often what happens is that, I don't know, it's like the number 51 bus. You can wait all day and there's no buses, and then 6 of them come all together, right? So trading can be like that sometimes, where there's not a heck of a lot of trades around, and then all of a sudden you're kind of seeing the opportunity for several trades at the same time, and what that means normally is that you're going to end up overexposing yourself to the market, and so you take those trades and you choose the best ones and you say, look, these are the ones which I'm going to be trading, right? So I'm a very conservative trader. I do trade intraday, and I take the odd shot here and there, but it's not the intraday trading which earns you the money. It's not the one that earns you the pips. It's small fry. Where you make the money is when you're catching those swings and you're getting involved in those fairly early on. And ordinarily what you find is that you can take a swing trade with a 500-600 pip target with the same risk definition that would have been involved in a trade that would have given you 40-50 pip target. Alright, so your R&R is much better as well, and that's what it's all about. You want to trade stress-free, and in order to trade stress-free, you want to take those trades where you have significant structural targets. And normally what I'm doing is I'm looking at a chart, and the entry is secondary. The entry is a secondary issue. It's more about being able to isolate a structural target using the chart, and realizing that it's a price attraction point, or the price has to visit some particular place. And once you've done that, it becomes relatively straightforward. But ordinarily 2, 3, 4 trades a week, and during the course of the month you have 2 or 3 very decent swing trades that you're looking at. That tends to be the state of play, right? So and I know the first time you walk into a casino, there's a lot of bells, a lot of whistles, a lot of lights flashing. That's very exciting, but if you're trading, you've got to be playing the long game, and if you play the long game, you'll make money. And if you're playing the short game and that's all that you're doing, it's very dangerous, it's very risky, right? So so my kind of net mix is that I'm looking for the swing trades, and those don't come along as often as we'd like them to, but I trade when they're there, and if they're not there, I'll kind of sit back and just wait, right? Okay. Short game, long game. It's the difference between doing position trading and intraday trading. And if you're trading intraday, and look, this is based upon my own experiences. I've been trading for longer than I care to remember now. It's almost been 8 years. And in that time, I've seen a lot of people come and go as well. And one of the things that you have to do is that, it's like when you're starting a business. When you start a business, you kind of look around and you say, okay, who's doing this really well? And you learn the lessons from them, and you say, okay, who's doing this really badly? And you look at the mistakes they're making, and then you want to avoid those mistakes. Trading is very much the same, right? So you look at people who are doing it really well, and you say, okay, what can I learn from those people? What are the principles which will lead to success? And at the same time, you look at people who are doing it really badly, like John is. Right? And you say, okay, what can I learn from that? And what are the mistakes which are being made, and how can I avoid those mistakes? Right? So, the long game, it means you want to be in this for a while, right? And you want to play. You want to be around after 5 years. You want to be around after 10 years. You want to be around after 30, 40 years, and you still want to be trading, and you still want to be making money. You find a lot of traders, they come and go, right? They're around a while, and then after that they just disappear. They disappear because their accounts are blown. There's no other reason for it, right? No one's. I very rarely believe that a hotshot trader comes along, shouting his mouth off, like a pair of bellows, the amount of wind coming out of his mouth, 6 months, about what a wonderful trader he is, and then he disappears. It's very hard for me to believe that he made millions and millions, and now he's gone off to find himself traveling around the world. All right? What's happened is he's blown his account, and he's flipping burgers in a McDonald's. That's what's happened. So you got to look at what that guy did and what he did wrong. What are the mistakes that he made? And say, let me not be making those mistakes. Principally, what are those mistakes? Every trade is a counter-trend trade, right? That is a mistake. When you want to trade, if you're trading conservatively, you need the wind in your sails. You want the structure to confirm what you're doing, right? What else is a mistake? Very poor risk definition. Overexposure to the market, initiating 10, 20, 30 trades at a time. So, there's a lot of kind of issues there. I guess tons and tons has been written about it as well. But if you want to be in it for the long term, then you really want to be looking at the longer term trades as well, because those are the ones that have the bigger payoff, and as well they give you much better risk definition, right? So so that's the kind of way to look at it. Don't make the mistakes. Don't make those errors. Don't make those mistakes that people make and then disappear. Okay, let's have a look. What else we got here? We'll talk about GBP USD weakening. Yeah. Okay, so I think I covered most of that already, but she's still going, I guess. There's still a little bit of room to the downside on that instrument. GKFX, GFT is doing 6 pips on that. That's not bad. Michael, John, how is your long-term bearish view on Euro USD reflected in Euro CHF and Euro JPY? Okay, I removed Euro CHF from my charts a long time ago, right? So if you're kind of looking across the bottom there, Euro CHF is nowhere to be seen, because as far as I'm concerned, there's nothing there which is worth trading, or at least the last time I looked at it, which was probably 6 or 7 months ago, there was nothing there which was of interest to me. We know that the SNB has declared a kind of floor on that, and they look as though they're going to be holding that floor for the time to come, right? So I don't really have an interest in that. As far as Euro JPY is concerned, I think that Euro JPY is going to be moving higher. I've discussed this in previous sessions. There's a lot of talk at the moment about this move in the yen crosses being cyclical. I don't think it's cyclical. I think it's more than that. She's up. She's up like what, 2,000 pips from her lows. Possibly she's got another 2,000 pips to go, right? And here 114 was the yearly opening price. I think as long as she's above 114, technically the long bias remains intact. Last week when we were looking at this, we isolated our support around these levels. The price pulled back to that area and ended up breaking north. Right now, from a structural point of view, you've just got to be looking at the last resistance area, which is coming in around the 120 handle now. So technically, as long as we're above 120, you're going to be looking for resistance to turn support around that area. and if that holds, then you can continue to look higher on this particular instrument, right? So that's the Euro JPY. It's just, very clearly an uptrend. At some point, you're going to get a significant correction on this, but my sensation is, in the words that I use and in the terminology that I use, that what it will be is a correction, but it will be a significant one, right? For the last 5 or 6 years, we've seen the yens and that kind of super trend heading down, and it didn't matter what price you were selling at, eventually the market would come and forgive you, right? But if you were buying, the market would not forgive you, and it would end up crushing you. So I think that the tables have turned on all of the yen crosses. It doesn't matter what price you're buying at. At some point you will be forgiven for that, right? Even if there's a significant correction, right? So if it happens as a significant correction, the price will still end up pulling back, and you'll get a resumption of this up move, and you will be forgiven for buying at that point. So set phasers to stun, and where are you, Jay? I'm sure I still you say there you are. Right, set phasers to stun, and buy whenever you're ready. But set your algos to buy on the yen crosses, right? That's I guess that would probably be the easiest way to describe it. Okay, what else have we got? Euro pessimist, yes. Much to my detriment, I am a Euro pessimist. I really think she's going to be back at parity, right? That's how crazy it is, right? So I'm looking for parity in Euro USD. The issue is she just needs to break in that direction first, right? So this is why, I'm prepared to miss like a 10,000 pip rally north on the Euro USD, but the moment I see her breaking south, I'm going to be giving chase. I am a Euro pessimist. Amazing stuff, yeah. That's just me. Alright, Toby's asking for GBP JPY. Toby, GBP JPY is the same as Euro JPY. Alright, so again, what you've got is structural support. And I think we looked at it last week where we looked at this block here, and we said basically you've got structural support which is being established here and here. And last week pulled back pretty much to the pip, and she gave a bounce off of that. Last week also said some expectation that GBP JPY may do this for a little while. So I'm just looking for consolidation from a technical perspective. As long as she remains above this block, she's a technical long, right? It doesn't matter whether you're 500 pips from that block, or 50 pips from that block, or 5 pips from that block. She's a technical long as long as she remains above this block. And my expectation is that she's going to do something like this. She may even go a little bit deeper into that block, but eventually after this consolidation, she's going to end up breaking north, and at that point we could be looking for another few thousand pips to the upside, right? So if you're looking at building a position on this instrument, then it's not unreasonable to be looking inside of this block to be building that position. The key issue, of course, like I said, is going to be risk definition and what that's going to be worth to you in terms of money. But from a structural point of view, the yens are about as clean as you can get right now, right? And the key issue is that, in an uptrend you want to be a buyer, right? You don't want to be a seller, which typically, because the market spends so much of the time ranging and you get used to kind of trading ranges, when the price is breaking out, you see a lot of traders are starting to exhibit fear, right? That because it's not something that you recognize, it's not something that you see happening every day, right? But again, I guess if we're talking about GBP JPY, you can set your phases to kill, set your algos to buy, and look for her to end up breaking higher out of these ranges, right? Don't be thinking that you're going to get don't be thinking that the price is going to be collapsing and heading back into the 30s unless that starts to happen first. And it's like I mentioned earlier, your uptrend typically looks like this, and your downtrend typically looks like this. If it's going to be a downtrend, let it start happening first. Once you recognize the structure, then you can kind of sell at will. Right now we're getting this kind of structure on the chart, and so we ought to be looking for those. We'll be looking for those continuation trades. And I guarantee you this much, right? Someone is going to be looking at GBP/JPY and saying inverse head and shoulders. The number of times people, I don't know why people are so fascinated with head and shoulders. It really kind of I find it strange, the fascination that people have with head and shoulders, right? But people will be looking at it's forming a head and shoulders, and automatically what happens is you end up putting yourself in a framework where you start taking those counter trend trades, right? Don't do it. It's a long, and it stays long until the bias turns short. As long as you're seeing resistance turning support, it's an uptrend. When you see support turning resistance, that's when it's a downtrend. Alright? So it's not a head and shoulders. Just assume that she's kind of making a base there, it's a consolidation, and eventually that will end up breaking higher. Okay? That's GBP/JPY. Let's have a look. GBP NZD, Go markets are doing 3.74. That's not bad. Okay, if they give you a fill. Alright, do I spend all week in front of charts? Yeah, you know what? I'm an addict, right? So I watch more than I trade, but I do spend, particularly most of the London session. So there was a time when I used to do about 16 hours a day in front of charts. When I used to close my eyes, I used to see candlesticks, right? But I do at least 5 or 6 hours a day in front of charts, mostly during the London session. That tends to be when I'm initiating most of my trades. Okay. Okay, mostly swinging, intraday weekly. Okay. My voice has a calming effect. Tell that to my wife. Okay, don't do shampoo trading. Yeah, no one likes shampoo trading. Okay, cheers, fellas. I think that's it, really. Right. So those are all the questions covered. We're almost coming up to the end of our time. Thank you all very much for attending this week and sticking out pretty much the whole of the presentation and not disappearing halfway through. It's always horrible when you start off with 40, 50 people and about 10 minutes in you're left with about 5. So it was quite nice to start off with about 10 and to see that building up during the course of the presentation. Cheers, fellas, as usual. Do take the opportunity to check out my website. It is www.tradingwithdeadlyaccuracy.com. In February, the first week of February, right? So we're talking February the 5th, 6th, and 7th. Well, that's next week, right? Next week we've got Legacy Group meeting taking place at the Holiday Inn in Birmingham. If you're interested in attending that, get in touch with me on Skype, WMD4XX. You will find more details about that program again on my website. There's a whole section about the Legacy program where it's about, but if you're looking at training as a trader, taking a game to the next level, then I think that will be something which will be worth taking a look at and something worth investing in. Again, thanks everyone for attending. Thank you as well to the team at FX Street for making this possible and providing the platform. I'll see you all next week. John's asking about how much it costs. It costs thousands and thousands, John, but I know you can afford it, mate. Right? So don't skimp out and don't be tight. Alright, see you all next week. Cheers, guys. Bye.